Today we're looking at 6 dividend stocks for the long term. We want to see a very safe dividend score of 80 or over. We want to see strong share price growth over the last 10 years of at least 100%. And we want to see long-term dividend growth of at least 10% on average year on year. As always, we're going to run through each of these companies. We'll look at their historical performance. We'll take a look at their dividend safety. We'll run into their financial metrics to see how strongly they've performed over the last 10 years. And as always, we will run them through the valuation model, getting to our intrinsic value as well as our acceptable buy price, given that investor margin of safety, and look towards Wall Street to see what they're forecasting over the next 12 months. Jumping into the first company, then we have S&P Global. Now, this is a company that is up 27% over the last year. We can see it's trading in the mid to upper end of the 52-week range, with a yield now of just under 1% and a forward PE of just over 30. Over the last 10 years as well, we can see it is up around 425%. Bear in mind, though, that this doesn't include those dividends reinvested. Dividend safety score, the safest score possibly obtainable at 99. Market cap 135 billion, a mega cap company. Now, in terms of those recessionary metrics, for those that see a recession inbound in 2024, well, they increased the dividend in 07-09, and they had below average growth, negative 38% versus the S&P's negative 12%. Dividend growth, well, this year it was very poor, 1.1%, well below that 4% we continuously advocate on the channel just to keep up in line with inflation. However, over the last 5 years and over the last 20 years, we see double-digit dividend growth, which is really what we want to see from our investing companies as dividend growth investors. They are also now officially a dividend king. They have increased those dividends consecutively for at least 50 years. In terms of dividend yield theory, now for those that are new to the channel, it states the company is undervalued when the current yield sits above the 5-year average. So what we have right now is a signal of reasonable valuation, 0.85 versus 0.89. And on the forward PE, we have a forward PE here of 30.7 versus the 5-year average of 28.9. So overall, you could argue reasonable valuation. Do bear in mind, though, we don't look at any of these models in isolation, and we will conclude towards the end. Financials also sitting at 11.9 for the sector PE, so much lower than S&P Global. As always, free cash flow payout over the earnings. As we mentioned continuously, earnings is susceptible to manipulation by management through accounting, and we run through some examples on the channel. Below 60% is my personal blanket preference for this ratio. Now, the reason why, below that, I do believe that management have that ability to offer those double-digit increases we love to see. For S&P Global, for the majority, it has barely touched over 40%, 2023 at 32%, 2024 going lower at 28%. I would like to see next January a much, much larger dividend towards the double digits that we've come to love with this company. Free cash flow per share, well, it has been increasing over the longer term, not as consistently as we like to see. $4.18 in 2014, $11.20 in 2023, expected to go higher in 2024. So overall, if this is one you are holding for the longer term, we can see it is increasing, which is a very positive sign. Sales growth for steady moderate growth, we're looking for 3 to 7%. What we can see, especially over the more recent period, double-digit growth to their top line. So that is very strong. We do love to see that. And when we look at that numerically, we see the price has gone from, or in fact their top line, from 5 billion in 2014 to 12.5, more than double over the last 10 years, looking very strong. Shares outstanding, what we love to see here is a decreasing count, meaning that companies are doing share buybacks, returning excess cash to investor pockets. Now, that is what we do see from 2014 down to 2021. Now, we do see it increase due to the merger that they had with IHS Markit, but overall, this is a company that does typically tend to do share buybacks, although we can see if you did buy in 2014, the net position would be a net dilution of shares. In terms of the ROIC, again, return on invested capital, one of those 7 golden dividend metrics that I like to see, looking very strong. Personally, I target 10% or more to give me faith that management are able to effectively allocate their capital. What we can see, it has dropped in 2022 and 2023. Again, due to that merger, it did impact these numbers. Before then, though, they were bringing out some very strong numbers in the mid-40s year on year. Something just to keep an eye on in the future to ensure it does come back to those very high levels we have come to love with S&P. Now, operating margin, very strong. 2014, they had some very strong operational efficiencies up to 2021. Even after the drop from what we mentioned earlier, we do still see some very strong numbers. 37% in 2023, looking very solid. And the same can be said for the free cash flow margin, 29% in the more recent year. Very strong. And overall, S&P Global is a free cash flow machine. This is what we like to see. Now, net debt to EBITDA, earnings before interest, tax, depreciation, amortization. For those that are new, these numbers effectively show the number of years it would take the company to pay off all of their debt net of cash on hand. And it signals two things for us. One, essentially, it signals the balance sheet strength. And two, it signals the dividend safety. 1.81 in 2023. I mean, before the merger, it was very, very low. Since then, it has increased. But what's nice to note, even after the increase, still well below 3. And in 2024, expected to go lower. So no worries with this company. A lot of very strong metrics. So let's jump into the valuation of SPGI. And as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we do run through all of these metrics to get to the intrinsic value calculation. For today's episode, let's jump straight into the value, which comes at $499 in today's episode. With a current price at $429, we typically start off with a margin of safety of 10%, and we use that if it meets 3 criteria. Wide moat, strong financial metrics, and good forward-looking data. If you believe that it is a buy up to $449, we keep going till it's near the current trading price, and at 15%, it is around $4 shy. So we see around 10 to 15% of a margin of safety based on our estimates and judgments of S&P Global. In terms of Wall Street and their forecast, well, they believe the share price is going a lot higher than the current value, with upside target of 15% and a price of $493. As always, let us know your thoughts in the comments below as we go through these companies. Let us know if you do see these as long-term dividend companies that have both strengths in their dividend safety, their dividend growth, as well as that share price return. The next company that we're taking a look at for the long term is Mastercard Incorporated. Now up 35% over the last year, and over the last 10 years up a very strong 512%. It is currently at its 52-week high with a forward yield of 0.55% and a forward P of 33.11. Another very safe dividend score of 99, market cap 445 billion, a mega cap company. Dividend recessionary metrics, well, they maintained it during the 07-09 crash. They had plus 2.1% average growth, which is very strong. And they also had an incredible recession return, negative 12, when the S&P at that point in time returned negative 55. Dividend growth, not really sure what else you want from a company. Plus 16% increase in December, plus 17 over the last 5 years, and 23% on average over the last 10 years is very, very strong, and it's one that I would expect to continue for the longer term with Mastercard, and we can see they have been increasing those dividends for the last 12 years. Dividend yield theory, well, we have a sign of reasonable valuation with the current yield pretty much in line with the 5-year average, and the forward P again pretty much in line with the 5-year average too, so a double sign of reasonable valuation, although we do note the financial sector P is significantly lower. Now, in terms of the free cash flow payout, lots to love here. In fact, it's not once over the last 10 years been above 25%, 21% in 2023, 20% in 2024. So this is why we do expect those dividend growth to continue with Mastercard. Free cash flow per share as well, absolutely phenomenal. This is probably as consistent as we see on the channel in terms of the growth year on year. $11.50 in 2023, $13.40 in 2024. Now, I know a lot of people watching this will be saying this company is overvalued, it's grown so much, but realistically, a company isn't overvalued if it continues to churn out some very strong numbers year on year, if it is growing at a very strong rate. So always bear that in mind, especially when we look at that margin of safety later on. Sales growth, double-digit increases to their top line nearly every single year. 13% in the more recent year, looking absolutely phenomenal. And we see their top line has nearly 3 times from 9.4 billion in 2014 to 25 in 2023. Shares outstanding, well, they also do share buybacks pretty consistently over the longer term, as we can see here, buying back around 250 million worth of shares. So ROIC, absolutely phenomenal, incredible numbers year on year. The consistency is absolutely insane. 61% in 2023, this is a company that has a lot of strong metrics, and it will be really difficult to find a lot of issues with it now. Operating margin as well, not only very consistent, but it has increased by around 3 percentage points from 2014 to 2023. And the free cash flow margin, this is ultimately a free cash flow machine. It is churning out very, very high numbers consistently over a long period of time. And the net debt to EBITDA looking very nice, 0.47 in 2023, 0.42 expected in 2024. So a lot of really, really strong metrics with Mastercard. So let's take a look at the valuation to see what we can find. So for today's episode of MA, we're getting to an intrinsic value of $528. What we can see then when using that 10% margin of safety, it is pretty much around $1 difference, so we do believe it has a 10% MOS level for this incredible company. In terms of Wall Street and their forecast, well, they see upside of around 7% with a target of $511 over the next 12 months. But as I always say on this channel, when a company continues to increase on that share price, Wall Street will revise their price targets and continue to increase it too. So always take this number with a pinch of salt. Now, before we move on to the next stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this, as well as all the other articles, all completely free, just click on that pinned comment below and you are ready to go. The next company we're looking at is Union Pacific Corporation, up 24.5% over the last year. Over the last 10 years, up around 170%. We can see it isn't too far from its all-time highs in 2022 of $273 and sits at the upper end of its 52-week high. A yield now just over 2% and a forward P of 23. Dividend safety score, very safe, 88. It is looking very strong. Market cap, $154 billion, a mega cap company. They increased the dividend during the last recession. They had below average growth, but they did slightly outperform the S&P with that negative 42% return. Dividend growth, we are still waiting for an increase from this company, although over the last 5 years and the last 20 years, we do see double-digit growth, and they have been increasing those dividends for the last 17 years. In terms of dividend yield theory, then we have a sign again of reasonable valuation, 2.06 versus 2.17, although we note the forward P does sit slightly higher at around 23 versus the 5-year average of 20, and industrials is sitting slightly lower at 19.7. So the free cash flow payout for most companies, as we say, 60%. We can see for the large part it has been below that. 2023 at 66%, 2024 expected to go lower at 54%. So I would like to see a double-digit increase to the dividend. Now, for a fairly cyclical company, we can see over the longer term, it is increasing pretty strongly. 339, in fact, more than doubled in 2023. In 2024, it is expected to go higher to 964. Taking a look at the sales growth, again, we can see that cyclicality. Some years of single or high single-digit growth followed by double-digit negative growth, and so on. There is that cyclicality aspect. 2023, negative 3%. And one of the key things to remember in a cyclical company is you always want to be buying them at the bottom of the cycle when they are out of favor, although it is easier said than done, which is why we do quite like the dollar cost averaging approach. In terms of total sales, well, it has barely moved if you just look at it over the longer term from 24 million to 24.1. One thing I do love about this company is their increasing share buybacks over the longer term. They've bought back nearly 300 million worth of shares. We can see a third, in fact, of the 2014 number. So that is very positive as a shareholder. ROIC number then, again, very strong, 15% in the more recent year. It is very consistent in those mid-teen numbers. So again, this is what we like to see, consistency on a very strong metric. Operating margin, very, very nice, above that 12% that we want to see, 38% in 2023. And again, the same could be said for free cash flow margin, looking very strong. So what I would say is while you're looking at these companies and we're running through them, always bear in mind what metrics are looking good and what you want to expect when you're analyzing maybe a new company that we haven't reviewed on the channel, or maybe one we haven't reviewed in a while, so you can see what kind of metrics to look for and at what numbers. Net debt to EBITDA, now this is one thing that is a little bit of a worry. It has increased from 2014, although 2.8 in 2023, the expectation is this is going to decrease in 2024 to 2.6. Now, in terms of the valuation of the company, let's find out. And don't forget, you can grab a copy of this model if you want to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list. So margin of safety at 10%. We can see it isn't quite a buy there yet. $236 is a little bit away. So right now we say it has a 5 to 10% margin of safety. In terms of Wall Street and their expectations, well, they see upside of 9%. They have a price target of $265, which is above our intrinsic value of $262. We then move on to the next company, which is Procter Gamble. Now, this is up 15% over the last year. Over the last 10 years, up 103%. It is trading at the upper end of the 52-week range with a yield of 2.4% and a forward PE of 25. Now, again, a very safe dividend score of 99, market cap 374 billion. It is a mega cap company. In terms of their metrics, well, they increased the dividend over the last recessionary period, above average growth, and they also outperformed the S&P. Dividend growth, now this is probably the only company we're going to go through today that doesn't meet this criteria on the dividend growth. We see a 3% increase in April last year, so we're expecting another increase next month. 6% over the last 5 years, 8% over the last 20 years. However, I have included this in today's episode due to the fact that it is a very high quality company and a very consistent one if you are looking for a safer place for a company in your portfolio. They're also a dividend king, so they have increased the dividend for 50 years or more, and they have been paying dividend for 133 years without a reduction, which is absolutely no joke. Now, in terms of dividend yield theory, we have a sign here of reasonable valuation again, 2.37 versus 2.48, and on the forward P, again, pretty much in line with that 5-year rolling average. It is, though, slightly higher than the consumer staples of 20.2. So, in terms of the free cash flow payout, we do see it below 70%, which is what you can extend it to if you want to look at industry-specific consumer staple numbers. 63% over the last 2 years, 57% in 2024, so no real worries with their payout ratio. Free cash flow per share as well, it has been increasing, maybe not as rapid as some of the other companies. Always good to understand the type of companies you're looking to invest in and just essentially play around with those expectations. 656 expected in 2024, so another increase from the prior year. So it is moving in the right direction consistently, but not as quickly as maybe we would like. Now, over the longer term, we do see their top line around that 3 to 7%. We do see 2014 to 2017 where their top line was reducing quite significantly, but they have managed to pull that back up over the more recent period. But again, this is a company that in reality, their top line is probably just about keeping up with inflation over that longer term. They do share buybacks. They have reduced the number from 2.9 billion to 2.47, which is always that added bonus. ROIC, not only in the more recent period is it very strong, but it has been increasing from a fairly decent level in 2014. Management are getting better. 21% in 2023 is a good sign in my opinion. Operating margin, well, again, we see the operating efficiencies improve, 19% in 2014, 23% in 2023, and we can say the same for the free cash flow margin. The last 2 years at 18%, looking very strong, and these are a lot of important metrics. As I mentioned earlier, you do want to be ensuring for other companies that you are looking to add in your portfolio, they are having these fairly strong numbers. Net debt to EBITDA pretty consistently as well, 1.39 in 2023, 1.15 in 2024. So a lot of quality here with this company, which you could argue as a fairly boring company, but sometimes those boring companies are nice to have in the portfolio just for some consistency. In terms of their valuation then, let's get into that intrinsic value. And for today's episode of Procter & Gamble, we have an intrinsic value of $173. Now, margin of safety, we start off with that 10%. We can see it's around $2 or $3 shy. So we see it right now trading at a 10% margin of safety. A lot of people with a company with quality like Procter & Gamble may be happy with that. You may also want to extend that to 15 or 20%. Again, it does depend on your risk strategy and profile. Wall Street, well, they have a profile, or in fact a forecast of $170. They have upside of 7% over the next 12 months. The next company we're taking a look at has had a bit of a beating over the last year, Deere Company, down 12% over the last year. However, over the last 10 years, some very strong performance, up 314%. They're pretty much trading towards the lower end of the 52-week range with a yield of 1.6% and a forward P of 13.4. Dividend safety, very safe, 83 score, market cap 102 billion, a mega cap company. Those recessionary metrics, well, they didn't increase the dividend, however, they didn't cut it, they purely maintained it. They had below average growth and they also trailed the S&P negative 65%. Dividend growth though, lots to love. Double-digit increase last full year, double-digit increase over the last 5 years, and double-digit increase over the last 20. So we can see they have been increasing those dividends for the last 3 years, given they maintained it in 2019, but they have been paying a dividend for the last 30 without a reduction. Now, in terms of dividend yield theory, we have a sign of undervaluation on the yield, but we also have another sign here on the forward P, so a double sign of undervaluation for Deere Company, and we do see it is much lower than the industrial sector P of 19.7. So in terms now of the free cash flow payout, we do see it pretty high in 2022. Now this is what I mean. Essentially, if you were to look at the earnings in 2022, 18%, you would be happy. But what this signals is that they paid out more in dividends than they generated in free cash flow. A red flag indicator, but nice to know in 2023, much lower, 2024 expected 20%. So no worries based on this information. Free cash flow per share, well, it has increased over the longer term. We do note 3 years of negative free cash flow, but since then it has been in the strong double digits. 2024 expected to go even higher, so lots to love with Deere Company. In terms of the sales growth, again, remember though, this is a fairly cyclical company. Last 3 years though, we love to see this strong double-digit revenue growth, and we can see over the longer term, it is increasing pretty nicely, going from 36 billion to 61. They also do share buybacks. In fact, all of the companies we have reviewed today do share buybacks, reducing their share count and therefore returning excess cash to investor pockets. Always nice to see this on top of those double-digit dividend increases. ROIC, they did go through a period where it was just purely single digits, but over the last 3 years, we see some very strong numbers. 18% for DE is looking very nice. Operating margin, again, pretty similar. They had some years where it was very poor, but since then, the operational efficiency of the company has improved. In the 20s over the last 3 years, looking very nice. Free cash flow margin, there was that dip in 2022, but since then, looking nice at 7%. Maybe 1 just to keep an eye on moving forwards, but overall, nothing major to report there. Net debt to EBITDA, pretty much 1 in 2023, 1.46, though we are expecting an increase in the next year, but even for the heavy equipment makers, it is still below that 2.5. So what about the valuation of DE? Let's find out. And don't forget, if you do enjoy this content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos. Margin of safety then, 10%. It is a buy up to 397. At 15%, it's still a buy up to 376. At 20%, not quite there yet. So we see at least a 15% margin of safety for DE. In terms of Wall Street, well, they expect upside of 15%. They have a price target of $423. And as always, let me know whether or not these are ones you are anticipating to add to the portfolio. We then move on to the final company that is a must for any portfolio. It is Microsoft Corporation. Now, this is up 69% over the last year. Over the last 10 years, just under 1,000%, looking incredibly strong. Now, it is towards that 52-week high. The yield is just under 1% and a forward PE of 35.5. No surprises, that dividend safety score, absolutely top-notch, 99. Market cap, 3.09 trillion, a mega cap company. In terms of those recessionary metrics, well, they maintained the dividend. They had average growth during the period, but they did also beat the S&P negative 48%, although marginally. Pretty consistent increases over the last year and last 5 years at that 10% level. Over the last 20 years, though, increasing to 19%, looking very strong. They are also increasing those dividends for the last 13 years, with 17 years without a reduction. So dividend yield theory, let's talk about that. We can see a double sign of overvaluation, 0.72 versus 34.3 and 30.2. But again, bear in mind, we're not looking at these in isolation. It is just one level of our research. And the information technology sector is much lower at 27. Now, no surprises when we look at the payout ratio, given how small it currently is, the yield. 34% in 2023, 31% in 2024. No worries there whatsoever. So again, I wouldn't be surprised with another 10 to 15% increase to the dividend this year. Free cash flow per share, again, more than doubled over the longer term. Expected to go much higher in 2024 at 9.72. So lots to love with Microsoft. Sales growth as well, nearly double digit every single year. We do see it did drop from that 18% we saw back to back in 21 and 22 to 7%. Nonetheless, still pretty strong for this company. Numerically then, we see it more than double from 87 billion in 2014 to 212 in 2023. And they do share buybacks, maybe not a massive amount, but they have reduced it from 8.4 billion to 7.47 over the last 10 years. Now, ROIC, again, no real surprise given the quality of this company. It is the company in the S&P with the largest market cap as well, over 3 trillion. 31% in 2023. Always nice to see it when they are very high. Again, they have improved their operational efficiencies, 32% in 2014, going up to 42%, which they've hit over the last 3 years. And the same to be said for the free cash flow margin, very consistent at a very strong number, 28% in the more recent year, well above that minimum 5% that we do target. Net debt to EBITDA, I mean, over the last 10 years, it wouldn't take them even one day to pay off all of their debt net of cash on hand. 2024 is expected to increase slightly to 0.22, but still no worries here whatsoever. So let's jump into the valuation of Microsoft, and don't forget, you can also run through all these companies we've been through today and change the estimates and judgments based on your own preference by grabbing a copy of the valuation model. So the intrinsic value coming to $433. Now with the current price at $416, a 10% margin of safety would be at $389. If we brought this to 5%, we see it isn't even quite there yet at a 5% margin of safety. But a lot of these companies that we have gone through are very high quality companies. A lot of people do tend to just dollar cost average every single week or every single month, completely depending on your profile as an investor and your goals and risks. In terms of Wall Street, well, surprisingly, in my opinion, they still in massive upside, 13%. They believe this share price is going to continue rising to $470. With the AI boom, they see that will very positively impact Microsoft. And Microsoft are one of those companies that does continue to surprise. They always tend to do a double beat on earnings. So it'll be interesting to see where the next few months will lead this share price. As always, let me know your thoughts about these companies, whether or not you are adding to any of them, whether or not you also agree for the longer term, these are some very strong companies. Bear in mind, they may not all be massively undervalued, but over the longer term, these companies do look like they will outperform. As always, let me know your thoughts. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you on the next one.